Hi, this is Scott McLeod with Brown Financial Advisory. I wanted to spend just a few minutes with you talking about what's going on in the markets right now. We've seen an increase in volatility, and the US market has sold off substantially, along with some other markets throughout the world. And I wanted to share with you just exactly what's going on. So the headline that I put here is a correction on the way, but it's well on the way and really just about to cross the line. The NASDAQ is in full correction territory. It's more heavily weighted toward technology companies. And the S&P 500 right at this moment is within a couple of percentage points of a full correction, a 10% decline in the market. So I wanted to add some context to that and share a little bit about what's going on in the global markets and our perspective on what's happening in the portfolio. First thing are just a couple of disclosures. And then our agenda today is to talk about the US market and the correction territory, exactly what's happening in the markets right now, showing how the diversification in our portfolio is actually helping in the way that we expected it would whenever we saw this volatility, but also as the Fed reacted to the volatility, lowering interest rates, et cetera. So in anticipation of that, the bond market has already begun declining in yields, and as a result is helping out in returns in those interest sensitive asset classes. And then finally, what happens over the full cycle when we face uncertainties like this? And we have a number of uncertainties this year with the Fed decisions and also the election coming up later in the year. We have a number of uncertainties around the world, global wars and so forth. So we've got a number of things that we have to face, and I'll address those in context as it pertains to the market in your portfolio. The first thing that I'll show you here is just where we are. This was through Friday, and you can see over the last 3 months, the market actually was up as much as 10% in mid-July, and then it started to sell off about mid-July. And now, as of Friday, it was only up 4.27%, which means we've lost upwards of 6% of that return. And then the market actually opened down this morning over 4%. So there's another 4% on top of that. That's not very helpful. After declining 6%, that's a full correction. But now the market has recovered a little bit. So we're still inside that correction territory on the S&P 500, but just barely. So we're absolutely starting to see that volatility as we described before. And which reminds me, if you haven't seen the video that I released the last time, there will be a link to that video in the description where I talk about the market valuations and just where those Magnificent Seven stocks lie in terms of overall valuation and also their percentage allocation in the S&P 500, which is what's creating a lot of this volatility. You can see right now this tech crunch is really what's causing most of the declines. In fact, if you look since July 8th, you can see that these 5 companies, NVIDIA, Meta, Amazon, Microsoft, and Google, are all down, with the exception of Meta, they're all down double digits just since July 8th. So NVIDIA is down 15%, Amazon 16%, Microsoft and Google in that 12.5% range. And that's really driving most of the volatility. I mentioned in the last video that the top 10 companies now account for 36% of the market value of the S&P 500. So whatever happens to those companies, and all of these companies fall in that category, whatever happens to those companies also happens to the S&P 500. So the diversification that you need in your portfolio is really against just having an overweight to US growth technology stocks in the portfolio, just by the nature of having the S&P 500 in the portfolio. Thankfully, you can see that the S&P 500 is not down nearly as much as the stock. So as I mentioned before, through 8.2, which is where this graph stops, we're still just down slightly for the quarter. And this is a 3-month return since July 8th. And so just basically, no, I'm sorry, since July 8th, not 3-month return, but just over the last few weeks. And the S&P 500 is down in the 5% range versus in the 9.59 to 15%, almost 15% range. So that's where a lot of that diversification comes in. In fact, it's interesting because if you look at that same time frame since July 8th, the S&P 500 is down 3.96, so just 4%. But the RSP, which is an equal weighted stock index. So the S&P 500 is market cap weighted, meaning the bigger companies have a bigger impact on the returns. The equal weighted portfolio is actually up 1.89 for that same time frame since July 8th. So what this means then is that the technology companies are pulling the stocks down, but the other stocks in the S&P 500 are actually increasing slightly. And that's encouraging because that means that it's a broader base increase versus what's happening in the S&P 500 as a whole and those technology stocks. Now, the one thing that I'll share with you about this correction is that corrections are normal. So I mentioned in the last video that we were expecting a little bit more volatility because of where the valuations were. And if you've had a meeting recently, I've also emphasized that we were anticipating a correction because we haven't had one in a while. But 10% corrections or 10 corrections are 10% declines or more. 10% declines or more actually occur on average about once every 18 months. So they're not unusual at all for us to see them. And just because we have them doesn't mean that there's some catastrophic event. In fact, right now, what's happening in Japan looks like just sheer fear that's cropped into that market, but crept into that market. But frankly, we're not in that same situation. And the U.S. market is relatively strong. The economy is relatively strong. The numbers have been weakening, but they've been weakening all year. And there isn't anything really that jumps out to say that, wow, we're in real trouble here. But whenever you see valuations increase like they've had, like they have in those top few stocks, then you're going to see volatility increase, and that's what we're seeing right now. So when we see 10% moves in the market, they occur about once every 18 months. It's nothing to panic about. In fact, you can see here that 5% declines in the market, which we saw over the last couple of weeks, are actually really quite common. About twice per year they occur on average. So whenever we see volatility and folks say, oh no, what's happening? I just remind them that the market goes up and down all the time. And as I said before, the market goes up more than it goes down over time. And that's where we get the reassurance that we're okay in long time frames. So this applies from 1954 to 2023. And if it occurs every 18 months, you should be expecting it. If you haven't had a correction in a year or so, which we really haven't, it's about time. And so I'm not really surprised at all that we're seeing this type of volatility. The next thing that I'll talk with you about is what's happening in the portfolio and how our portfolio diversification is helping the allocation. As I've mentioned before in our meetings and also in the videos, there were two parts to the bounce. We received a lot of the equity bounce in 2023 after the declines in 2022, but we were waiting on some of the more interest-sensitive assets to bounce as the interest rates begin to decline. Well, lo and behold, we've seen really significant bond yield declines just over the last few weeks. In fact, the 3-month yield through 8/2/2024 is not 2204, but 2024 actually peaked out. The 10-year Treasury note peaked out at 4.62, and the current is 3.81. So full 80 basis points of decline in yield. And isn't that interesting? Because the Fed hasn't lowered interest rates yet, but the bond market's kind of anticipating the slowdown in the economy and pricing in that the Fed is going to take action later on this year. And most economists really think that the Fed will likely lower interest rates in September, if not before. And so, but really think that September is kind of the time frame for the first decrease in interest rates that we've seen in some time. But the 10-year note has already priced that in. And as you know, whenever the interest rates decline, we start to see those interest rate sensitive assets take off. And we really have. So in this time frame, the 1-month returns, the S&P 500 is down about 4% for the month. And now we're seeing the interest-sensitive assets bouncing in that same time frame through 8/2. So BBTLX is just the Vanguard Total Bond Market Index. That's a great proxy for the Barclays Aggregate Bond Index. It's actually up 2.83% in a month. So you annualize that number, and that's a big annual number. But this is the type of bounce that we would expect to see with a 75 basis point decrease in interest rates. So we're expecting to see a pretty significant bounce. And this is actually principal bounce. This is not interest. This is the bounce in the value of the bonds themselves. And then to that, you apply the yield for the year's return. And this gives you a yield in the 7-8% range just for that Barclays Aggregate Bond Index, which is exactly what we've been describing the reaction bonds will have whenever the Fed starts to lower interest rates. Another interest-sensitive asset, of course, is real estate. And we saw a rout in real estate during the interest rate increases. Now we're seeing an incredible bounce. So just in this time frame, the 1-month return for the U.S. real estate index, and this is the Dimensional Fund Real Estate Fund, the index is up 7.8. 7.08%, and 8.72% for the DFA real estate fund. So this is exactly what I was talking about. These are incredible returns. If you annualize those returns, you just get astronomical numbers. And those are the 1 month returns, immediate reaction to what happens to the funds, the perception, if you will, of those asset classes whenever the interest rates decline. Bonds always go up in value whenever the interest rates decline, the principal value increases. And real estate has been so beaten down and it looks so terrible for so long with the interest rates high that when the interest rates start coming down, we start seeing a takeoff in real estate. And we would expect that to continue, especially given the fact that we expect interest rates to continue to decline over the next year or so. Now, one thing that I wanted to point out, and I pointed this out in the last video, is just that we're starting to see the projections for U.S. returns coming down because of where valuations are. And this should give you an indication, I mentioned this in the last video, an indication of where the averages will likely end up. And so therefore, if we're way above the average like we have been all year, we're likely to revert back to that mean. But this is the report from Vanguard, the capital markets model from Vanguard, and just shows their projected returns. And basically, if you look at U.S. equities, their 10-year, 5 to 10-year returns, they're expecting 3.3 to 5.3%. Now, this is on an asset class that typically returns about 10%, and over the last 15 years has returned upwards of 15%. So now they're thinking that 3.3 to 5.3 based on growth rates and also the valuations, that combination suggests that the returns will be much lower. Well, what about growth stocks? You know, where all those AI stocks are really taking off, like Amazon, Microsoft, Nvidia, Google, et cetera. Oh my goodness, those growth stocks projected only 0.4 to 2.4%. So there's a really not a whole lot of upside left in that market. So the fact that we're seeing those stocks sell off a little bit because the earnings maybe weren't quite as strong as they thought they would be, or the growth has not been quite as fast as they thought those stocks would be, this is not really very surprising at all. On the other hand, international is expected to do really well. Global equities ex-US in total, 6.7 to 8.7. Developing markets or developed markets, 6.7 to 8.7. And emerging markets, 6 to 8%. So we're seeing really strong projected returns in the international space. And also down here, if you look on bonds, you know, our yields a few years ago were in the 2 to 4% range, and now they're expecting treasuries to go 4 to 5, and intermediate credit 4.7 to 5.7, high yield corporates in the 5.4 to 6.4% range. So now our bond portfolio is actually going to generate a pretty healthy portion of the return. So that 60-40 allocation, which is kind of the classic allocation, is now benefiting from having that bond exposure. So again, this reinforces, and same thing I said last time, reinforces that what we're seeing right now is not unusual. It should be expected, because as much as we like to see these returns, as the saying goes, trees don't grow to the sky. And so as a result, we would see those declines kind of reverting back to the mean and getting those stocks that have been overbought back into a normal territory. Will they grow? Absolutely, they'll grow. They'll grow much faster, it seems, than maybe they were growing pre-AI. But on the other hand, just how fast can they grow and how expensive can the stock be before it's outrageous? And I think we may have hit that tipping point. The last thing is facing the uncertainties in the upcoming months. And we've had a few questions about this from our clients. And that's the reason I wanted to address the question. You know, in particular, one thing is what happens in presidential elections. And we've talked about that before. But this, as you probably acknowledge, is one of the more unusual presidential elections that we've had. And as a result, maybe there is a little more uncertainty. And what about, you know, the things that are going on in the Middle East? How will that impact the U.S.? And what about the debt in the U.S. right now that we don't seem to be addressing or really even talking much about, but the U.S. Economy still seems to be accumulating an awful lot of government debt. And how do we address that? There are just questions on questions on questions right now. And all those questions kind of pile into a little bit of uncertainty, especially over the next few months, maybe even the next couple of years. And the thing that I want to describe for you is that uncertainty is something that we're accustomed to. It happens Frequently, don't remember a time that there was no uncertainty. So there's almost always some degree of uncertainty. But the thing that makes it a little bit different is the market seems to march right through that uncertainty all the time. And what I mean by that is you can track this back to the 1970s, and you may remember that time between 1972 and 1974 was terrible for the stock market. In fact, it fell in this early part of the 1970s, and then fell again, just declines dramatically in the early part of the 1970s. It was down 43%. Oil prices quadrupled because the Arab oil embargo, and we saw this dramatic impact on the economy. It wasn't long after that that the question came up in Business Week about the death of equities. And you can see that there is volatility. This was a big decline at the time. And you come out here to the 1980s and inflation hits 13.5%, and we see the market decline a little bit. And then we start to recover, and all of a sudden we see this massive growth right here, right before Black Monday hits, and it's down 23%. But it recovered pretty quickly after that, relatively speaking. And then we saw this savings and loan crisis that hit right after that. Income taxes go up here. We see an Asian currency crisis, a Russian financial crisis, the Y2K scare, and then all of a sudden we see the dot-com crash that wipes out a significant portion. It was 3 years. I was there during that time frame, 3 years of returns happening here. The 9/11 terrorist attacks didn't help. You see these just combined risks and fears that show up all throughout the market. But the thing that I want to point out is that if you had invested $1 in 1970, that dollar would be worth $69 right now. So what happens is there's volatility that's like a bouncing ball, and I describe it as a bouncing ball bouncing upstairs. It just keeps bouncing, and it keeps increasing all through the uncertainties. Now the uncertainties will create short-term volatility. Short-term is relative. I mean, this was a 3-year period that it impacted here, so that was a pretty big deal. And then 2008, of course, the Great Recession, that was also a pretty big deal. So we saw some pretty significant declines during these periods, but with patience, you see a dollar grow to $69. And you say, well, Scott, I don't have 50 years to wait for this stuff to come back. Maybe it's going to be a little bit longer, or 55 years for me to get my $69. I mean, can you imagine if you had invested, instead of $1, maybe you'd invested $100,000, what that would be worth 69 times over. That's a pretty good number. But maybe you don't have 50 years to wait to watch the market come back or to see that kind of growth again. The thing that I wanted to share with you is that we talk about the way we perceive our market performance in long-term perspective. So long-term perspective is 5 years, and that's not really that long. But the thing about 5 years that's magic is that there is a market cycle that occurs in the typical 5-year period, and it helps make sure that the portfolio returns are positive during that time frame. So in spite of all the uncertainties and everything, all the terrible pictures that you can paint, and I've heard it many times, well, Scott, this time it's different. Well, it's different every time, and that's what makes it a whole lot the same. But when you map this out, the Vanguard 60/40 allocation, which is one of their life strategy funds, it dates back to 1994. And when we do the rolling 1-month projection on this fund, there are 273 5-year time frames since 1994 for each of the months that we started. So we started in January of 1994 and project that for 5 years, and February of 94 and project that for 5 years, and actually started in April. So we project that in for 5 years, and each one of those accounts for a 5-year return. Well, those 5-year returns have ranged anywhere from upwards of 17-18% here, just over 15% here, to just barely positive here at the end of 2002. But there were only 3 periods out of 273 periods where the 5-year return ended up negative, and the worst case was about 2%. So when we talk with our clients about the last 28 years, this is mapped out through April of 2022. But when we talk about the last 28 years, this is where you can draw assurance from what happens in the market. There would be short-term volatility and fears related to corrections and market movements and economic decline. However, when you consider 5-year time frames, and most of us will be here for the 5-year time frame, those 5-year time frames are positive more than 99% of the time. So 5-year time frames are positive 99% of the time. And that should be the reassuring factor when you're considering what's happening in your portfolio. So yes, there will be some volatility, and yes, you'll see some uncertainty along the way. But the thing about it is the market tends to march right through that because it tends to be built on things like valuations and growth rates and earnings, and not so much the daily news cycle and the things that frighten us every day. In our portfolio, we keep this Core Plus strategy. The Core Plus strategy is designed to take a core portfolio and just build around that core in order to enhance the return and reduce the volatility. And it is successful in these timeframes, but not so much when you're thinking about a year or 6 months or 2 years. It's more along those 5-year timeframes that you start to see those really positive results. And so the portfolio outperforms in those timeframes as the result of that additional diversification and that little plus that goes on top of the allocation. I'll be happy to describe that for you when we're together again and let you know really what that means in terms of your allocation. But I want to thank you for the time. I know it's an uncertain time, and I want to just reassure you that we feel confident that over just a little bit of time, this volatility will subside. And when it does, you'll see those returns kind of return back to normal. You'll see those things in your portfolio pick up like they were before. And in the meantime, I just hope you'll be reassured that the market does this periodically. It's nothing to worry about. It goes up and down all the time, but it goes up more than it goes down. And that's how we win over time. So please let me know if you have any questions, and I look forward to seeing you again soon.